15 minutes. That's all it took for someone to bet $500 million on oil prices, minutes before the president even confirmed a ceasefire with Iran. While American missiles were still in the air, Wall Street was already placing its bets. Lockheed Martin's stock more than doubled. Saudi Aramco's profits jumped 26% in a single quarter. And the total bill for this war, more than $113 billion and rising, landed squarely on the American taxpayer. Not Tehran, not Tel Aviv, Washington. This is a war measured in missiles and casualties on the news, but on Wall Street it was measured in stock charts and quarterly earnings. Somebody knew exactly what was coming before it happened, and somebody else is still paying for it, whether they know it or not. To understand how that happened, we need to go back to the moment this war actually began. To understand how Wall Street profited from this war, you first need to understand how the war itself began and why it turned into one of the most expensive conflicts of the decade almost overnight. In late February 2026, the United States and Israel launched a coordinated military operation against Iran, publicly framed as a response to an imminent nuclear threat. Officials called it Operation Epic Fury. Within days, Iran's supreme leader was dead, and a conflict that had been simmering for years moved from tension to open warfare in a matter of hours. Iran did not absorb the strikes quietly. It retaliated by hitting American bases across the Persian Gulf and by partially closing the Strait of Hormuz, the narrow waterway through which roughly 1/5 of the world's oil supply passes every single day. Within weeks, Hezbollah entered the conflict from Lebanon, and what had started as a targeted operation against a single country expanded into a multi-front regional war. Analysts who had spent years describing a slow-burning rivalry between Iran, Israel, and the United States suddenly had to describe something else entirely: an active, multi-theater conflict with global economic exposure, one that touched shipping lanes, energy markets, and defense budgets on nearly every continent within a matter of weeks. For most people watching the news, this looked like a story about missiles, borders, and casualties. That story was real, and it was serious, and it deserves to be treated as such. But for institutional investors, defense contractors, and oil traders, the same events were read as something else entirely: a signal. A signal that government spending was about to surge, a signal that oil supply was about to tighten, and a signal that a small number of companies were about to become significantly more valuable, almost regardless of how the war actually turned out on the ground, or how long it lasted, or which side eventually claimed the upper hand in any given month. Within the first 6 days alone, the Pentagon told Congress the war had already cost $11.3 billion. That number would climb and climb again over the following months, eventually settling above $113 billion for the first 108 days of fighting. Meanwhile, oil prices jumped 15% in the first week, pushing Brent crude toward $83 a barrel, not because a single tanker had yet been destroyed, but because the market was pricing in the risk that one might be. That distinction matters more than it might first appear. Markets don't wait for damage to happen before they react to the possibility of damage, which means the financial consequences of a war can arrive before the military consequences are even clear. This is the part of the story that rarely makes it into the nightly news. A war is not just a military event. It's an economic shockwave that moves through markets, contracts, and balance sheets almost instantly, often faster than the military situation itself develops, and far faster than most viewers assume when they picture how these things typically unfold. When the first strikes happened, defense stocks didn't wait for the outcome of the war to react. They moved within hours of the first headlines. Analysts tracking defense industry data noted that RTX shares had climbed roughly 110% over the prior 3 years, with a sharp acceleration tied directly to the Iran conflict. Northrop Grumman rose about 60% over the same window. General Dynamics gained 57%. Lockheed Martin climbed 37%. These aren't hypothetical numbers, they're documented market performance, tracked by financial data providers and referenced directly in congressional hearings about defense spending, presented as evidence in the same rooms where lawmakers were debating whether to approve more funding. At the same time, the disruption near Hormuz sent a different kind of shockwave through the global economy, one that touched almost everyone, whether they lived in the Middle East or not. Oil is priced globally, which means a supply threat in one region raises prices everywhere, from gas stations in Ohio to shipping companies in Singapore, to manufacturing plants across Asia that depend on stable fuel costs to plan their budgets months in advance. Insurance premiums on tankers moving through the region spiked as underwriters priced in the possibility of an attack, sometimes doubling or tripling the cost of insuring a single voyage. Shipping companies began quietly rerouting vessels, adding days and fuel costs to journeys that used to be routine, passing those costs down the chain to importers, retailers, and eventually to consumers who never hear the words Strait of Hormuz, but still pay slightly more for goods that arrived by ship. The World Bank would later cite this exact war as the central reason for cutting its global growth forecast for the year down to 2.5%. That is not a small revision. It represents trillions of dollars in economic activity that the world's leading development institution now expects will simply not happen in dozens of countries that have nothing to do with Iran, Israel, or the United States, because a war 8,000 miles away made borrowing more expensive and energy less predictable for everyone trying to plan a budget, a business expansion, or a national development program. So by the end of the first month, two parallel stories were unfolding side by side, largely disconnected in how they were covered. One was military, airstrikes, retaliation, a fragile ceasefire that would break and reform more than once over the following months. The other was financial, rising defense stocks, rising oil prices, and a rising bill that someone somewhere was going to have to pay, whether or not that person had ever heard of Operation Epic Fury. The question this documentary exists to answer is simple to ask and considerably harder to answer honestly. Who was on which side of that ledger, and how much of it came down to timing, information, and access that ordinary people simply didn't have? To understand how this war turned into a financial event, you have to follow 3 separate rivers of money, all flowing at the same time, often invisible to anyone who isn't specifically looking for them, and each operating on its own logic, its own timeline, and its own set of winners. The first river is government spending. When missiles are fired, munitions are used, and equipment is deployed, the Pentagon doesn't pay for that after the war ends. It pays continuously, in real time, through supplemental funding requests submitted to Congress. This is a specific bureaucratic process. The Department of Defense calculates operational costs, submits a request, and Congress votes to approve additional appropriations outside the normal annual budget cycle, often under significant political pressure to move quickly once troops are already engaged. By mid-May, Pentagon officials told Senate committees the war was costing roughly $25 billion, and that figure would need to climb further. By June, the Pentagon was requesting an additional $80 billion in supplemental funding just to keep operations running at their current pace. That money doesn't disappear into a black hole, and it doesn't stay with the government. It flows directly into contracts with Lockheed Martin for missile systems, with RTX for radar and munitions, with Northrop Grumman for aircraft components and maintenance, with L3 Harris for communications and surveillance equipment. Every dollar the government spends on this war becomes revenue on someone else's balance sheet, and every quarter that revenue gets reported to shareholders as evidence that the business is healthy and growing, regardless of how the underlying conflict is actually progressing. The third river is the one most people never hear about at all: financial markets reacting to information before the public does. On March 22nd, President Trump announced a pause in strikes through a social media post. 15 minutes before that post went live, someone placed a bet worth roughly $580 million on oil futures, a bet that only made sense if you already knew prices were about to move and in which direction they would move. It happened again on April 7th, this time with a $950 million position placed just before a ceasefire announcement, and again on April 17th with a $750 million trade timed almost perfectly around another presidential statement. 3 trades, 3 separate announcements, and a combined notional value of over $2 billion, all moved in tight windows that a random guess would be extremely unlikely to hit 3 times in a row, let alone in the same direction each time. Congressman Richie Torres formally requested that the Securities and Exchange Commission and the Commodity Futures Trading Commission investigate these trades. As of this recording, those investigations are still ongoing. Nobody has been charged and no wrongdoing has been proven. It's worth being precise about what that means. A trade being well-timed is not automatically the same as a trade being illegal. Sophisticated traders sometimes are simply faster at reading public signals, troop movements, diplomatic cables, satellite imagery available to paying subscribers, even patterns in flight data around military installations, than the average investor sitting at home. The alternative explanation is less charitable, that someone had access to non-public information about a presidential announcement and used that access to place a bet that couldn't lose. Both explanations remain on the table until regulators finish their work, and this documentary won't pretend to know which one is correct before they do. What connects all 3 rivers is that none of them require anyone to have predicted the war or to have taken a side in it. A defense contractor doesn't need Iran to lose. It needs the war to continue long enough to justify the next contract and the one after that. An oil producer doesn't need any particular political outcome. It needs the supply threat to persist long enough to keep prices elevated above where they would otherwise sit. And a trader who moved $500 million 15 minutes before a presidential announcement didn't need to understand geopolitics at all. It needed access to information before everyone else received it, whether that access came from analysis, from luck, or from something regulators are still trying to determine. 3 rivers: government spending, oil pricing, and market timing, all converging into the same place: profit for a small number of players and cost for almost everyone else, regardless of who eventually wins the war on the ground or how the history books eventually describe it.
Let's be specific about who actually sat on the winning side of this war, because the answer is more concentrated than most people assume, and the mechanism behind each winner is different enough that it's worth walking through one at a time rather than lumping them together as one vague category called war profiteers. Start with the defense industry. Lockheed Martin, RTX, Northrop Grumman, General Dynamics, and L3Harris aren't just companies that happen to make weapons. They're companies whose entire business model depends on sustained government demand and whose stock valuations are built around the expectation that this demand will keep growing rather than shrinking over time. When a war escalates, their order backlogs grow, and Wall Street prices that growth in almost immediately, long before the weapons are even delivered, let alone used in combat. That's why RTX stock could climb over 100% even while the war was still active and unresolved. Investors weren't betting on the outcome of the war. They were betting on the certainty that whoever wins, these companies get paid, and that the check clears regardless of the ceasefire's exact terms or how long it holds. Then there's Saudi Aramco. As the world's largest oil producer,
Aramco doesn't need the war to go any particular way to benefit from it. It simply needs oil prices to stay elevated, which a closed or threatened Strait of Hormuz guarantees almost automatically, without Aramco having to lift a single finger or take a public position on the conflict at all. A 26% jump in quarterly profit isn't a rounding error or an accounting adjustment buried in a footnote. It's billions of additional dollars flowing into a company that didn't fire a single shot, didn't lose a single employee to the fighting, and didn't take on any of the operational risk that came with the war itself, simply because it happened to be sitting on production capacity that suddenly became more valuable the moment a choke point came under threat. And then there's a less visible winner. Countries positioned to buy discounted oil from sanctioned or war-affected sellers. India, for example, was able to continue purchasing Russian and Iranian oil at reduced prices under specific waivers negotiated with U.S. authorities, effectively profiting from the very instability that was raising prices for everyone else. This is one of the stranger asymmetries of modern conflict. The same disruption that punishes most buyers can, for a buyer with the right diplomatic relationships and the right waivers already in place, become a discount window that lasts exactly as long as the crisis does and closes the moment stability returns. What connects all of these winners is not luck, it's position. Defense contractors are positioned inside the government spending pipeline, with contracts that were negotiated years before this specific war began, and relationships with the Pentagon that predate any single conflict. Aramco is positioned inside the global oil supply chain, controlling production capacity that took decades and hundreds of billions of dollars to build, capacity that simply happened to become more valuable the moment a choke point came under threat. Countries like India are positioned as buyers with access to discounted, war-adjacent oil, a position built through years of careful diplomatic balancing between Washington, Moscow, and Tehran, maintained precisely so that options like this would be available when a crisis eventually arrived. None of them needed to predict this particular war precisely. They only needed to already be standing in the right place when it happened, which is a very different skill than being right about geopolitics, and arguably a much more reliable one. This is the mechanism that rarely gets explained clearly in the news coverage of any war. Profit during wartime has very little to do with taking sides and everything to do with structural position. A defense company doesn't need Iran to lose, it needs the war to continue. An oil producer doesn't need any particular political outcome, it needs the supply threat to persist. And a trader who moved $500 million 15 minutes before a presidential announcement didn't need to understand geopolitics at all. They needed access to information before everyone else received it. This is why the same war that appeared chaotic and unpredictable on the nightly news looked, from a market perspective, almost mechanical, almost boringly predictable if you knew where to look and which numbers to watch. Rising tension, rising stock prices, rising risk, rising oil prices, and rising uncertainty for a handful of trades, apparently rising profit with suspicious precision. The people capturing that value were rarely the ones making decisions about the war itself, and rarely the ones whose names appeared in any headline about it. They were the ones positioned to benefit from it, regardless of how it unfolded, and regardless of who was actually winning on the ground in any given week of the conflict. It's worth pausing on how unusual this speed is historically. In past conflicts, the lag between military escalation and financial reaction could take weeks or months, limited by how quickly information traveled and how quickly capital could be redeployed from one position to another. In this war, that lag compressed to hours, sometimes minutes, as trading algorithms and news monitoring systems closed a gap that used to give ordinary investors at least a fighting chance to react. The speed itself is part of the story, a signal of how tightly integrated modern financial markets have become with the flow of political and military information, for better or worse, and a preview of how future conflicts may be priced in real time before most people even understand what's happening.
Now turn the ledger over, because every dollar of profit in this war came from somewhere, and most of it came from people who never had a seat at the table where these decisions were made. Start with the most direct number, $113.3 billion. That's what the war cost American taxpayers in just the first 108 days, according to Pentagon figures presented to Congress. And that number kept climbing. By June, the Pentagon was requesting an additional $80 billion in supplemental funding just to sustain operations at their current pace, with no clear ceiling in sight at the time, and no guarantee that even that figure would be the last request. This is money that comes directly from the federal budget, money that in any other year might have funded infrastructure repair, healthcare subsidies, education grants, or simply reduced the deficit that every American taxpayer indirectly carries. Instead, it was redirected into munitions, logistics, and military operations on the other side of the world. It's easy to treat a number like $113 billion as abstract, a line on a spreadsheet that doesn't touch anyone's actual life. It isn't abstract. It shows up in very concrete ways, in higher interest payments on the federal debt that has to be serviced every year, regardless of what it was spent on, in tighter budgets for domestic programs that get deprioritized when defense spending takes precedence, and in economic pressure that eventually reaches ordinary households through inflation and borrowing costs that have nothing to do with their own financial decisions or spending habits. Federal Reserve officials pointed to war-driven oil price spikes as one factor complicating interest rate decisions in 2026. Decisions that directly affect mortgage rates for American homebuyers, auto loan rates for anyone financing a car, and credit card interest for households already stretched thin before the war even began. In other words, a war fought thousands of miles away, over territory most Americans couldn't locate on a map, still reached into the monthly payment on a house in Ohio or Arizona, through a chain of cause and effect that most people never see connected in the news coverage they consume, because the connection between a Middle Eastern ceasefire and a mortgage statement simply isn't the kind of story that fits into a 90-second segment. And the American taxpayer wasn't alone in absorbing the cost. Inside Iran, the economic toll was severe and immediate. Food price inflation surged over 100% within a year, as sanctions, war damage, and currency instability collided at once, compounding each other in ways that made the crisis worse than any single factor alone would have caused. Civilians there paid in a currency far more direct than dollars: scarcity, displacement, and the daily hardship of trying to feed a family when the price of basic staples doubles in 12 months. This is not a footnote to the financial story. It's the other end of the same mechanism that generated profit elsewhere. The same war, viewed from the side of the ledger that rarely gets a segment on the evening news and rarely gets mentioned in the same breath as a defense contractor's earnings call. Across the Gulf region, countries dependent on tourism and aviation saw both industries disrupted for months, even in nations that weren't directly involved in the fighting. Airlines rerouted flights around the conflict zone, adding fuel costs and flight time to routes that used to be efficient and predictable. Hotels in cities that market themselves as safe, stable destinations suddenly had to convince travelers otherwise, often unsuccessfully, as bookings dropped and cancellations rose across an entire tourism season. And on a global scale, the World Bank estimated that developing economies would need somewhere between $60 and $100 billion in additional support to absorb the shock the war sent through commodity markets and trade routes. Support that has to come from somewhere, whether that's international aid budgets already stretched thin, new borrowing that adds to existing debt burdens, or economies simply absorbing the pain directly through slower growth and higher prices. None of these costs were equally distributed, and they never are in any modern conflict. The countries and companies with financial insulation, deep capital reserves, government contracts, structural advantages built over years or decades, absorbed the war as an opportunity to grow. The countries and households without that insulation absorbed it as a direct hit to their stability, with no comparable upside to offset the damage they took on.
This is the part of the story that rarely gets said out loud in polite economic analysis. War doesn't spread its costs equally, and it never has in this conflict or in any before it. It concentrates gains at the top of the financial system, among those already positioned to capture them, and it disperses losses across everyone underneath who had no say in the decisions that created the war in the first place, and no way to opt out of paying for it. It's worth naming the asymmetry directly, because it's easy to lose in a wall of large numbers. The same war that added tens of billions of dollars to a handful of corporate balance sheets also added measurable strain to a school budget in a mid-sized American city, to a family in Tehran deciding which staple to cut first, and to a hotel worker in the Gulf whose hours were quietly reduced because tourists stopped booking rooms. These are not separate stories happening to coincide. They are the same financial mechanism observed from opposite ends. One end shows up as a rising stock chart. The other shows up as a grocery receipt that costs more than it did last year, or a paycheck that arrives a little smaller than it used to, month after month, without ever making the connection to a war on the other side of the world.
Money moving during a war is one story. Money turning into lasting power is a different, bigger one. And this is where the Iran war reveals something about how modern conflict actually works. Something that goes well beyond who made a profit in any given quarter. Consider the defense industry first. Every dollar spent on this war didn't just generate a quarterly profit, it reinforced a permanent argument that sustained military readiness requires sustained military spending, and that any reduction in that spending would leave the country exposed the next time a crisis erupts. Once Congress approves $80 billion in supplemental funding, that spending doesn't simply vanish when the war ends. It becomes the new baseline for future budget negotiations, new contracts, new production lines that take years to spin up and even longer to shut back down. A war doesn't just generate revenue once, it resets the floor for how much a government is expected to spend going forward. And that floor rarely moves back down to where it started, because dismantling production capacity is politically harder than expanding it, and because the companies benefiting from that floor have every incentive to defend it in Washington. That's how a temporary conflict quietly becomes a permanent structural advantage for a small number of companies whose survival depends on exactly that kind of spending continuing indefinitely, year after year, budget cycle after budget cycle, regardless of which party controls Congress or the White House. Congressional budget analysts have noted this pattern before in conflict after conflict. A supplemental request framed as an emergency measure has a way of quietly becoming part of the baseline expectation for the following year's regular appropriations process. Once a defense contractor has expanded its production capacity and hired staff to meet wartime demand, there's a natural institutional pressure to keep that capacity funded, since shutting it down means politically painful layoffs in districts that lawmakers represent. Now consider oil. A closed or threatened Strait of Hormuz doesn't just raise prices during the crisis, it reshapes who countries trust to supply their energy for years afterward. Nations that watched 20% of the world's oil supply become a bargaining chip started rethinking their dependency on a single choke point, and those conversations don't stay theoretical for long. That reconsideration doesn't happen overnight, and it doesn't happen for free. It shows up later as new pipeline agreements, new long-term contracts with alternative suppliers, and shifting alliances between energy producers and energy-hungry economies like India and China, alliances that can outlast the ceasefire by years or even decades. None of this shows up in a single headline because it isn't a single event. It's a slow accumulation of decisions made by people who don't want to be caught exposed the next time a choke point becomes a war zone, and who are willing to pay a premium now in new contracts, new routes, new diplomatic relations to avoid paying a much larger premium later. That accumulation is harder to see than a missile strike,
but it may end up mattering more to the shape of the global economy a decade from now. This is where capital stops being just a number on a balance sheet. It becomes leverage. The countries and companies that emerged from this war with more cash, more contracts, or more strategic relevance didn't just get richer, they got more influence over what happens next in rooms where decisions get made long before they reach the public. Saudi Arabia's position as a stable oil supplier, even during regional chaos, strengthens its bargaining power with every country that depends on that stability. And that leverage doesn't expire when the ceasefire is signed. The American defense industry's expanded contracts don't just fund this year's weapons, they fund next decade's research, next decade's technology, and next decade's global military presence, extending an advantage that compounds over multiple budget cycles rather than resetting after each conflict ends. There's a broader pattern worth naming here. When trading activity around sensitive government announcements draws regulatory attention, the typical outcome isn't just fines for individuals, it's tighter rules about who can access market-moving information before it becomes public, and when, and through what channel. If the current investigations into these oil futures trades confirm a pattern of improper access, the most lasting consequence may not be the fines themselves, but a new layer of scrutiny over how financial markets are allowed to react to presidential statements about war and peace. That would be the deepest transformation of all. Not just money turning into power, but a single war quietly reshaping the rules of the market itself, long after the ceasefire is signed and the headlines have moved on to the next crisis. It's worth being honest about the limits of what we can say here. We don't yet know how the investigations will conclude, and we won't pretend otherwise. What we can say is that the incentive structure is already visible, regardless of how any single case is resolved. Being close to power, or close to the information power generates, has become a measurable financial advantage in a way that's easier to document with each successive crisis. That's not a conspiracy theory. It's simply what the trading data, the congressional testimony, and the earnings reports already show, laid side by side, without requiring any hidden meeting or secret arrangement to explain it. Think of it this way. Nobody needs a conspiracy for capital to flow towards power. Markets are built to reward exactly that kind of positioning, openly and legally most of the time. What this war exposes is how much faster and how much larger that reward has become as financial markets, government spending, and geopolitical information have all grown more tightly connected to one another over the past decade. The missiles stopped or paused more than once during this conflict. The capital that moved because of them kept working long after each pause. Some of it is still working today, compounding quietly in portfolios, contracts, and pipelines that most people never think to connect back to a war that technically, on paper, already ended.
If you've stayed with us this far, subscribe to Capital and Consequence and join us for more long-form documentaries about money, power, and the consequences behind the headlines. Now, as of this recording, this story is not finished. On July 8th, the ceasefire that had held for weeks broke down, and the United States resumed strikes against Iran. Oil prices, which had fallen back to pre-war levels in the weeks after the truce, immediately began climbing again toward the low 90s per barrel. This matters because it means every mechanism we've just described, defense spending, oil pricing, and market timing, is active again in real time as this documentary is being released, not as a historical case study, but as a live, ongoing situation. So what happens next depends on a handful of variables that are still genuinely uncertain, and this documentary won't pretend to know the answer to any of them with more confidence than the evidence currently supports. If the conflict re-escalates into a sustained multi-month engagement, available evidence suggests defense contractor revenue would likely continue climbing, simply because sustained conflict requires sustained resupply, and resupply requires new contracts on top of the ones already signed. That's not a prediction of victory or defeat for either side.
It's a structural likelihood based on how these companies are positioned within the broader defense spending pipeline, regardless of the war's eventual outcome. If the Strait of Hormuz faces renewed disruption, oil-dependent economies in Asia could face a second wave of the same fuel rationing and cost pressure they experienced earlier this year, with less time to prepare and fewer reserves left to draw on after already absorbing one shock. Producers with alternative export routes, like Saudi Arabia's East-West pipeline that bypasses the strait entirely, could see their strategic value rise even further, simply by virtue of not depending on the one choke point everyone is now watching. There's also a less certain but important thread still unresolved: the ongoing SEC and CFTC investigations into the suspicious oil futures trades made before presidential announcements. Under one scenario, the trades could confirm coordinated insider trading, leading to charges, fines, and a broader conversation about market oversight during geopolitical crises, one that could reshape how financial regulators treat trading activity around government statements for years to come. Under another scenario, the trades could be found to reflect aggressive but legal speculation based on public signals that sophisticated traders read faster than the rest of the market, using tools and analysis available to anyone willing to pay for them. As of now, the evidence available publicly doesn't allow a definitive conclusion either way, and it would be irresponsible to present one. What we can say with more confidence is this: whether the war ends in the coming weeks or drags on for months, the financial architecture around it is already built. The contracts are signed, the production lines are running, often at expanded capacity that took months to bring online and won't be dismantled quickly. The capital is positioned in stock prices, in supply agreements, in diplomatic arrangements that were made specifically to hedge against exactly this kind of prolonged instability. Wars end, the financial infrastructure built around them almost never fully unwinds, because unwinding it would require someone to voluntarily give up a structural advantage they spent months or years building, and institutions rarely do that without significant external pressure forcing the issue. Consider what winding down would actually require in this case. It would mean defense contractors voluntarily shrinking backlogs that shareholders currently reward. It would mean oil producers accepting lower prices once a supply threat fades, even though nothing in a producer's business model requires giving back a windfall. And it would mean regulators building new oversight mechanisms fast enough to catch the next round of well-timed trades before they happen again, rather than after the fact, once the money has already moved and the position has already been closed out for a profit. And that may be the most important pattern in this entire story, not who wins the war on the ground, which will eventually be settled one way or another, but who has already won the war on the balance sheet, regardless of how the fighting ends and regardless of which headlines dominate the news cycle in the weeks that follow any eventual resolution. The next chapter of this story may not be written by generals or diplomats at all. It may already be written in contracts, hedges, and positions that were locked in months ago, quietly waiting for the rest of the world to catch up.
So let's go back to where this documentary began. 15 minutes before a presidential announcement, $500 million moved into oil futures. That single moment captures everything this story is really about. Not because it's the largest number in this documentary, but because of how precisely it compresses months of financial mechanism into a single, verifiable data point. This was never simply a war between Iran, Israel, and the United States. It was also a war that generated over $113 billion in costs to American taxpayers. A war that pushed Aramco's profits up 26% in a single quarter. A war that sent defense contractor stocks climbing well over 100%, and a war that, according to congressional inquiries still unresolved, may have allowed a small number of traders to profit from information the rest of the world didn't have.
The missiles were fired by governments, but the money moved through markets. And those markets don't ask who is right or wrong. They only ask who is positioned to benefit and how quickly they can act on that position once the information becomes available, whether that information arrives through public channels or something else entirely. That's the uncomfortable truth sitting underneath this entire conflict. While the human and political story played out in headlines about ceasefires, retaliation, and diplomacy, a parallel financial story played out in earnings reports, defense contracts, and oil futures, largely invisible to the public paying for it and largely absent from the news segments most people relied on to understand what was actually happening. It's tempting to treat these as two separate stories that happen to share a timeline. They aren't. They are the same war, described in two different vocabularies. One vocabulary uses the language of ceasefires, casualties, and diplomacy. The other uses the language of quarterly earnings, basis points, and supplemental appropriations. Both are accurate. Neither is complete without the other. And most coverage of this war, this documentary included, has to work hard to hold both vocabularies in view at the same time. Think back to every figure this documentary has walked through. The $11.3 billion in the first 6 days, the 110% rise in RTX shares, the 26% jump in Aramco's quarterly profit, the 2.5% global growth forecast, the $2 billion in suspiciously well-timed trades. None of these numbers exist in isolation. Each one is a data point in a single continuous financial story that started the moment the first missile was launched and is, as of this recording, still being written in real time. Put them side by side and a pattern comes into focus that no single number could show on its own. Money moved toward the same handful of positions again and again, regardless of which week's headline described a ceasefire holding or a ceasefire collapsing. That consistency is itself a kind of evidence, not proof of wrongdoing, but proof that the financial architecture around this war was built to capture value from volatility itself, not from any particular outcome. And here's the part that outlasts any single ceasefire or any single headline. Wars end, eventually, one way or another. The financial structures built around them rarely do. The defense contract signed during this conflict will shape budgets for years. The oil price expectations set during this crisis will influence energy strategy long after the fighting stops. The question of who knew what and when may still be working its way through regulators long after this documentary is published, and long after most people have stopped paying attention to a war that, by then, will feel like old news. Money didn't just follow this war. In some very real ways, money anticipated it, priced it, and outlasted it. That sequence, anticipation, pricing, and endurance may be the closest thing to a universal law this documentary can offer, one that applies well beyond this particular conflict and will almost certainly apply to whichever crisis comes next. Consider what that sequence actually implies. Anticipation means capital was already positioned before the first strike, in contracts, in production capacity, in diplomatic relations built over years, long before any headline used the words Operation Epic Fury. Pricing means markets translated that anticipation into concrete numbers, stock valuations, oil prices, futures contracts, often within hours of events that took governments days or weeks to fully respond to. And endurance means those numbers, once set, don't reset themselves just because a ceasefire gets signed or a headline moves on to the next story. They persist in portfolios, in budgets, in the baseline assumptions that shape the next round of decisions, long after the guns have gone quiet. If there's one thing worth carrying away from this story, it's this. The next time a geopolitical crisis dominates the headlines, the more important question may be not who wins the conflict, it's who already positioned themselves to win the money behind it, long before the first missile was ever fired, and long before anyone else understood what was actually at stake. If you found this breakdown valuable, subscribe to Capital and Consequence for more documentaries following the money behind the world's biggest conflicts. Give this video a like if it changed how you see this war. Share it with someone who follows markets or global politics. And leave a comment. Do you think Wall Street's gains from this war were fair game, or something regulators should have caught sooner? Let us know what financial story behind a global conflict we should investigate next. For viewers who want the full research dossier behind this documentary, the Capital and Consequence dossier is available in the description. Until the next documentary,
Capital and Consequence. Follow the money. Understand the consequences.